Right on. Hello and welcome to The Upside with Eli. Today we've got Dylan Rieberer again in the studio. Dylan, thanks for joining me.
It's always a pleasure.
Yeah, today we are talking about kind of retirement planning and all the common mistakes that people make. I think we're on episode 11 now of the podcast.
Nice.
We're
Double digits.
We're double digits. Yeah. What are we talking about today, Dylan?
Yeah, common retirement mistakes. I mean, there's a lot we could go into. So we're gonna, keep it within half hour kind of thing. But the very first thing, probably the biggest mistake of all, and a lot falls under this, is your drawdown strategy. Namely, whether or not you even have one in the first place, and whether or not it's well thought out and well calculated. To illustrate just how important this is, I've got a brand new case that's fresh top of mind. Basically, with this client, the difference between the optimal drawdown strategy, which I calculated for them, compared to not even the worst case, but just kind of the base case that our planning software spits out, the difference between those two in terms of present value of their lifetime taxes, which I'll explain that in a second, was $1.4 million, right? So to put it in just really simple English, the difference between the optimal scenario and just an okay scenario for them for drawdown strategies was basically an extra $1.4 million of wealth that they could spend, donate, gift to their children or grandchildren, like do whatever they want with it. So if you're not following
and for perspective, like how large is that client? In terms of an asset base, because that wasn't even like a high net worth individual. That was more of a mass market, kind of retail size client.
Yeah, like I mean, they would still be considered high net worth, okay. but like upper middle class, right? Like probably a lot of the people watching this podcast would fall in a similar asset range to them, right? So for a slightly above average person, that could be what you're leaving on the table, is certainly hundreds of thousands of dollars for pretty much everyone, up to millions of dollars, right? Just by this one thing. And your drawdown strategy, I mean, like I said, there's a lot of sub points that we'll talk about today, but your drawdown strategy is basically the skeleton of your entire retirement plan. So if you don't take care of that, I mean, everything else, it's basically impossible to get back on track no matter what else you do if you don't do that step right. So that's the very first one, and that's probably the thing we'll spend the most time on today is having a proper drawdown strategy. Yeah,
and then just kind of going through a lot of the common mistakes that people make when they're retiring. And ideally, retirement is something you do once. That is the ultimate goal, to not have to retire twice, to do it correctly the first time around. So in terms of common mistakes, one we want to start off with was kind of not using general rules of thumb instead of using actual math, right? We should use actual math. So what does that actually mean?
Yeah, I mean, so that's the first thing, right? Is like a lot of people here might have been like, "Okay, I know what a drawdown strategy is," and if you don't, we'll talk about that. But a lot of people might be here where they're either working with the planner, someone giving them financial advice, or they're doing it themselves and they've read some articles, they've watched some videos, whatever, on the topic of drawdown strategies. But the problem with that is it's all generic, right? And like I said, the difference between not even the worst case that you could choose, but just the generic strategies from having an optimized strategy is hundreds of thousands or millions of dollars in wealth that you're just leaving, right? So, that's kind of the beauty of like the fun part of our job, is that there is no one right answer, but that's necessarily, by default, what you're getting when you get generic advice is you're getting generic strategies. RRIF meltdowns, taking your non-registered or TFSA first, taking mixed withdrawals, taking RRIF and LIF first, I've even seen, right? Everyone's and their dog has an opinion on these things. The thing is, they're all both right and wrong, just depending on the circumstance. And you see it all the time too, right? Where people will come in off the street with some level of financial knowledge, and it's taking them from that to the fully optimized, saving as much in tax as possible, for example, making your money go as far as possible. The difference between the two is, did you actually calculate it or not?
Yeah. And the other rule of thumb we often see, and I'm just getting such a range on this stuff now on social media, is, it was the 4% rule that came out, and Caleb Hammer's talking about the 3% rule that he subscribes to. There's another, fairly popular kind of ex-advisor on TikTok who's talking about the 6% rule. And it's just, all of this stuff is so situation dependent. So just build it based on your actual situation rather than using these generic rules of thumb, which don't really mean much because they're not factoring in all of the factors. They're just assuming a drawdown like a pool of capital, but it doesn't factor in life expectancy. It doesn't factor in pensions. It doesn't factor in income split. Like it doesn't factor in your goals, investment returns, any of that kind of stuff, right? So
longevity. Yeah.
So what's going to happen is either A, you're leaving money on the table, B, you're going to run out of money, or C, you're going to retire and having not been able to kind of like live the life that you could have potentially, kind of had. So, so the first kind of major blunder we wanted to talk about was taking RRIF income at the wrong time. What does that mean to you?
Yeah, so this is, again, getting back to some of that general advice is like a very common one, and probably for the longest time, certainly from like tax accountants, the advice was just delay your RRIFs as long as possible. And to be very clear, there is obviously a benefit, or maybe it's not obvious, but there's a benefit to deferring tax, right? If you can leave more of your money invested rather than paying it to the tax man today, you'll have even more money down the road to pay higher tax bills, to spend more, whatever. So there's a benefit to delaying tax. There's also obviously a benefit to paying less tax total. And usually those are two directly conflicting goals, which leads us directly into when to take your RRIFs, right? That's a key part of your drawdown strategy. Most people are going to retire with some amount of RSPs, which, in case you didn't know, that's what turns into a RRIF account. So the common advice for a long time was delay those as long as possible to 71. If you had a younger spouse, delay it till they're 71, right? Just never take any money out of your RRIFs. For one thing, one very obvious thing to think about is, well, do you actually need the income? I mean, you don't want to just not live and spend any money just because you don't want to pay tax. That's not the solution.
But we'll see people who do that.
Oh, 100% all the time, right? So first things first is, again, having an actual plan. One of the basic building blocks of that is how much income do you need? Because that's kind of what everything flows from.
Totally.
And then from a tax perspective, right, in a lot of cases, and this is, again, where only the math will dictate and allow you to actually know. Otherwise, to do anything short of the math, the time value of money math, financial math goes by a lot of different names. To do anything less than that is to just kind of be guessing, right, and going based off general strategies. But if you're taking, if you're delaying your RRIFs as long as possible, the advantage of that is you're pushing that tax off as long as possible, right? So maybe you're drawing from your non-registered accounts or your TFSA or both first, right? And there is a benefit to that. And in some cases, it works. But it also, sometimes people could be better off taking their RRIF payments earlier, like right at the start of retirement, for example, spreading the tax on those withdrawals out over as many years as possible, so that rather than being in like a very low tax bracket to start, and then when you hit 71, now you're up here.
Yeah, being you're in a way higher tax bracket, all of a sudden it bumps you up.
Right, yep. You're averaging things out, you're equalizing things. What that does by taking RRIFs early is it usually lowers your average tax rate over life. The trade-off being now you're paying some of that tax up front, right? So you're not deferring as much. Which option is right for which person? Every single person watching this podcast is going to have a slightly different answer. Yep. Some people, it's best if they fully defer their RRIFs as long as possible, like the more traditional advice says. Other people are actually better off. I've even seen a few select cases where you're better off like purposefully drawing down all your RRIFs before you even touch your non-registered and your lower tax stuff.
Sure, yep.
Most of the cases I've seen, the answer is somewhere in the middle, but it's not like 50-50. It's anywhere from 1% to 99% RRIF versus non-reg, all the way to the opposite, and everything in between. Like, it depends on the exact specific taxable income, longevity, like how much income you need, how much you have in RRIF versus TFSA, like so many things, right?
Yeah, absolutely, and that's not looking at the RRIF kind of in a silo. There's other aspects of it where if you convert a RRIF, you convert to a RRIF, say at 65. You're going to get the pension tax credit, right? So it's not a massive savings. It's a $2,000 tax credit at 15%, so it's an extra $300 a year in tax savings, but it's still $300 a year in tax savings that you can get by drawing out of that if you didn't have, kind of other forms of pension. There's also the ability to income split, so depending on whether you have, kind of company pensions or not, because you can't split OAS, right? CPP, you can obviously share credits and stuff from it, but that's another advantage to being able to draw down, and maybe you couldn't split out of, corporate, if you're getting dividends from a corporation or something like that where your spouse isn't on it. So, and I think a lot of people do just default, by nature, just because they hate the idea of paying any tax. But a lot of times now, it's like when you start to retire, that's when we actually start to draw from that RRIF. Obviously, you're going to run it out, but I would definitely agree there's a lot of factors that go into that one that people just don't actually fully go through.
Yeah, and so I mean, if you're getting frustrated watching this podcast, as like every time we give an answer to something, the answer ultimately is always just, it depends, do the math. And I mean, I wish we could give a better answer. We can to our actual clients when we do the math. If you're just watching from home, I mean, learn financial math. That's the best way to do it. But other than that, right? Yeah, like I said, the first retirement mistake is just not having a drawdown strategy. The second mistake is not having a calculated one. Just kind of going.
And the drawdown strategy is the general, and then kind of what we're going through are all the different pieces that make up that drawdown strategy, right? Which takes us to our next one. So not unlocking a LIRA when converting it to a LIF. So for those of you who aren't familiar with it, if you have a defined contribution pension plan, when you leave that employer, it's going to roll over to either a locked-in retirement account or an LRSP, depending on if it's a provincial or federal federally registered pension. And when you have the ability to convert that to an income stream, it converts over to a LIF, a life income fund. When you do that one conversion, you can unlock 50% of it and roll it into your RSP. And the reason why you would do that is because LIRAs or LIF have a maximum withdrawal per year, right? And so RSPs don't. So let's say you have a reduced life expectancy, or you want to be able to access more capital because you want to buy that cabin, or you want to take more trips, or you just want to spend more money earlier in your retirement rather than thinking you need the same amount of money every single year. The ability to unlock that 50%, you may never see the benefit of that, but a lot of people do. Right, get that benefit. You still have to pay tax when you pull it out, but it just gives you so much more flexibility. There is zero downside to doing that 50% unlocking when you roll your LIRA over to a LIF.
Yeah, exactly. And I mean, the only problem is, like, if you're watching from BC, for example, they don't have that 50% unlocking provision. But like Ontario, Alberta, most of the provinces do. There's also a lot of other unlocking provisions. So, just in general, unlock your LIF. Like you said, there's really no downside. Even if you're not actually starting to take money out of your LIF account, right? You can just unlock it and put it half of that or however much you are allowed to unlock into your RSP or RRIF account, and then go from there. But at least now you're not constrained by those maximums.
Yeah, and I do like the idea of drawing maximums out of that LIF account, once it's converted over to LIF, rather than doing a minimum, right? Rather than pulling more out of RSPs, right? Get rid of that LIF, kind of first and foremost, if you're going to be drawing from your registered assets anyways. So yeah, I would say the unlocking and then doing the maximum. It just gives you more flexibility.
I was going to say, yeah, because I mean, like, so why would you tell people to do that for those listening? Like, what's aside from tax, right? Because this isn't just the tax conversation when it comes to LIRAs and LIFs. Why would you tell people to kind of err on the side of getting rid of those accounts?
Yeah, if you're going to be drawing from one of the accounts anyways, like RSP versus the LIRA, I would draw from that one and get the max out of it first, because there's less flexibility. And let's say you do have a reduced life expectancy, and we know you're going to pass away in X number of years, and we want to spread that tax liability out over a shorter period of time. You just have way more flexibility if it's inside of an RSP.
Yep, and we've seen people many times before. I mean, with a lot of the clients we work with now, not as much, but like, especially for a lot of people out there, especially if that's all you have is a LIRA or a LIF. I mean, we've seen it where people literally can't pay their bills, can't spend their money because they're constrained by those maximums. And that's why the unlocking provisions exist in the first place. But for example, like the financial hardship unlocking provision, which is one that's available in every province, it's a very strict requirement. Like, you basically have to be facing like eviction or defaulting on your mortgage before they'll let you take extra money out.
Yeah, they're more for extreme, kind of scenarios where there's really no other option.
It's not like if you want a boat or something.
No, unfortunately, they did not include boat on the list. Cool. Next one, taking CPP and OAS at inopportune times. This is always a very heated topic online. A lot of people are kind of on one side of just, well, I paid into this, I want to get my money out because I could die tomorrow. And then on the other hand, you get people who, actually sit down and do the math and say, all right, why don't I defer all this stuff to 70? Because if I'm going to live past 83, I'm actually going to be, better off for it. And then you get, everybody, kind of in between. So what are the main things that people should be understanding when it comes to how the deferral bonus works and when they should take CPP and OAS?
Yeah, I mean, that's another thing, right? A big kind of theme of today is, just taking an active role rather than, like, for example, OAS just starts unless you tell them you want to defer it. So taking an active role, thinking about this ahead of time, coordinating it with all your other incomes, because there's a lot that goes into when to start any pension, especially, CPP OAS. For those who don't know, OAS, you can't start earlier than 65, but you can delay to 70. You get a 0.7% per month increase, 0.6% per month increase to OAS for every month that you delay up to age 70. For CPP, you can take it as early as 60, as late as 70. You get an increase of 0.7% per month for every month you delay, and you get a decrease to your regular benefit you get a 0.6% decrease for every month you take it early. So there's kind of the base information to know. So basically, long story short, if you take your pensions, your government benefits before 65, if possible, you're going to get a decreased pension for life. That's a permanent decrease. And if you delay them to 70, you get a permanent increase. So that set the stage. What was the second part of that question? Sorry.
Yeah, just in terms of the question, and that's a perfect, kind of overview of the deferral mechanism. Just to put it in kind of like terms of like real numbers, we're talking a 36% difference from deferring from 65 to 70, and a 42% difference, right, in income from 60 to 65 for CPP. So it's not immaterial. It can make a huge difference when you think that there's like some 3 million plus Canadians who live just on OAS and CPP, and maybe a little bit of GIS, right? So. It affects a large number of people. The other part of it was just, understand like, okay, well, when do I take it?
Yeah,
and there's a lot of other factors that play into that in terms of, maybe I'll let you run through that one. But what are the main factors that you see when trying to explain to people when to take it, other than life expectancy?
Yeah, in terms of general factors, age is probably the main one, right? If you expect to live for a long time, you're all else equal. So all these things I'm saying are all else equal. Just going through each factor individually. Age, the longer you expect to live, the better off you are deferring it, right? You're going to get that higher benefit for a longer period of time. Whereas if you expect, if you have reasons like genetic, like family health history, or just other reasons to think you're not going to live that long, like you said, 83 is kind of where that break-even point tends to happen. But if you're planning to live less long than that, right, then you're probably better off taking it sooner, getting what you can out of those plans. That's one aspect of it. Your other taxable income is a big part. For example, another case I just worked on, the client they're much higher net worth, right? But just from their RRIF and LIF minimums alone, they're already going to be over the OAS clawback limit.
Yep.
So for them, it's in their best interest to defer their RRIF payments as long as possible. Once those start at 71, we've deferred tax as long as possible. There's nothing else we can do. They're going to be over OAS clawback. So for them, it makes sense take it at 65. At least get 5 years of OAS, and then it's all going to get clawed back after that, regardless of what they do.
Sure.
So that's another kind of like circumstantial thing for people to think about is, like what other types of income, what other sources of income are you going to have? I know you put a note in here too to talk about like how dividends specifically for anyone who's got their own companies that are incorporated, how do dividends affect OAS? I don't know if you want to talk about that one or if you want me to.
Yeah, so for anyone who owns a business, right, when you've got cash that's left over inside of whether it's a holding company or maybe you're still running the business and it's just kind of going on by the side, right, you've only paid corporate tax out of the smaller, the general business rate. When you dividend money out of your corporation, if you actually look on your tax return, the dividends get grossed up. And then you get a subsequent tax credit, right, to basically counteract that, right? That's where tax integration comes into play. The problem is that your OAS clawback is based on the grossed up amount, right? So on a certain type of dividend, your income, say you drew $100,000 in dividends, it actually gets grossed up 38%. So it's as if you had income of $138,000, which takes you from a little bit of clawback to 100% clawback. And so what we'll often try to do is we want to pull as much money out of a corporation as we can before you start your OAS. Otherwise, you're just going to lose it all to clawback anyways, right? So it kind of in terms of like structuring things differently. The other factor is, if you are still working and creating an income and you're over that, threshold anyways, of course it makes sense to defer OAS because you're just going to get all clawed back. Like the number of times we've run into people, they've come to us at 66, 67, 68, and they're like, well, I've already started OAS. And we go like, well, why? Because you have to pay it all back. So you're not only have you not been able to get the deferral bonus, but now you don't even get to collect it for those 3-4 years anyways, right? And it's just because it's automatic, right? As soon as you turn 65, they turn that tap on. Whereas CPP, you have to elect into OAS. You get a letter 11 months before your 65th birthday. You're supposed to, and then you have to opt out of getting it. So yeah, there's the gross up mechanism, there's the mechanism of if you're still working, and all of those factors kind of play into it. You might add CPP to that mix. Will taking CPP plus dividends or plus my income, put me over that threshold where I'm going to lose my OAS anyways. So it's kind of playing in all of those different factors kind of combined. And like you say, it's building all that out, kind of over a 30-year timeline to see, okay, what is the most efficient way to build that drawdown structure.
Yep, and that's so those are just like, there's a lot more we can talk about just on the income side, but those are two great examples of thinking about the other income you have in light of when to take your pensions. So there's, to refresh, there's how long you expect to live, what other sources of income you have, and how do they play into things like OAS clawback, things like your tax bracket, right? Are they going to push you into a new tax bracket? Also investment returns. That permanent increase, right, that 36 or 42% permanent increase to your benefit from those plans, that's actually a pretty high investment threshold, like, to meet, where like a lot of people say, oh, well, I'm actually just going to take my CBP or my OAS, before I actually even need the money and just reinvest it. That is a viable strategy, but you have to be getting pretty high investment returns to make it worthwhile. And that's, also keep in mind, you're now giving up guaranteed income versus a non-guaranteed rate of return. But that's another option. Again, sometimes it works. I think, I don't want to say most of the time for any of this, but I think most of the time, this is coming from someone who's like an investment manager, I'd say probably that's a high threshold to meet, but it is doable.
It depends on if those assets are going to go into like a TFSA or if they're in a non-registered account where you got to pay tax on the growth too, right? And in terms of like the risk tolerance of a client, like I had a guy call me the other day, and he was kind of below our threshold for a typical client that we would work with. But I tried to give him all the advice that I could, and his whole thing was he was just he had a small investment portfolio, but it was 100% GICs, right? And he goes, well, I want to continue to grow the money before I take that on. You're not going to outperform the deferral bonus, so I would draw down on your registered assets first, right? Because you're not earning very much, you're just a GIC investor. One, he shouldn't be, and that's a whole other conversation. You should be build a proper portfolio for retirement. But it made sense in his scenario to say, yeah, defer OAS, defer CPP, and draw your other assets first, because you're not going to outperform those the way you're kind of investing currently.
Yeah. It's not on our list, but really quick, I want to add to one other kind of common retirement plan or mistake I see is, so far we've talked a lot about tax and a lot about OAS clawback, things like that. It's the same mistake, but it's opposite sides of the coin. Sometimes people focus entirely on tax, do everything to save tax instead of taking other steps. For example, like a lot of people won't rebalance their growth-oriented, pre-retirement portfolio to a proper retirement portfolio because they don't want to pay tax on it.
Yeah,
it's not just a tax decision there. There's a lot of other factors that go into whether or not you should do that.
We call that letting the tax tail wag the dog.
Yeah, right. And on the flip side too, like I've seen a lot of people say like, oh, like who cares about OAS clawback? It's meant for lower, like to middle income seniors. I'm getting it clawback because I don't need it. Fair enough, but also like you don't need to go out of your way to pay what's essentially an additional 15% tax, right? Like that's So there's kind of two sides of that coin too. That's a common mistake, I would say.
Yeah, no, that's 100%. So the next one we have is not taking advantage of low earning years before starting pension. So this could be corporate pension, there's OAS, CPP, but we kind of break this down into a few categories. So some of the main things that you can do, let's say you go into retirement, you haven't started your company pension yet, right? Or maybe you can, but there might be some benefit to actually deferring OAS, deferring CPP, to do things like stepping up your adjusted cost basis, selling off rental properties, triggering some of those large gains you have in kind of growth equities, things like RRIF, LIF, meltdowns, selling off your shares in your company, your business, things like that. Why don't you walk us through that?
Yeah, so basically, this especially not exclusively, but especially applies to people who retire a little early. Right, so before you can even start like CPP and OAS, if you even wanted to.
Yeah, they retire between say 50 and 65.
Yeah, right. So those kinds of people, for the most part, basically now you've got those years where you're not making any more income from employment, and you haven't started your pensions, which are all taxable income as well. So you've got this period of time where you've got these not low earning, but low taxable income years, right? And that's a really great time to take advantage of quite a few different planning techniques. All of them basically are on the same lines as trying to realize some of that taxable income on purpose up front when you're in a really low or potentially no tax bracket. so that you then have way less tax to pay for the rest of your lives. So a couple examples of that, you already listed them off, right? Like purposefully bumping up the adjusted cost basis of your investments. For people who don't know what that means, basically selling your investments and even buying them right back or switching your portfolio at that time. Basically, you're purposefully realizing all your gains, paying tax on them when you have low or no other taxable income. And now you've reset. So only the gains from that point on are going to be taxed when you start making regular withdrawals from like your non-registered account instead of having, especially if you've been investing for 3-4 decades, right, leading up into retirement, you're going to have, no matter how bad of an investor you are, you're going to have quite a few gains, right, to realize. So that's one example. RRIF meltdowns, which are becoming more well known, which is, I think, a good thing for the most part. I've seen a lot of people who don't understand the purpose of RRIF meltdowns. It's another time, right, if you've got, or like LIF meltdowns too. If you kind of just want to get rid of those accounts because they're locked in, it's a great time to start, purposefully taking some money out of those accounts, pay a very low amount, or like I said, even no tax on those. And then, you maybe just move it all into like your TFSA at that point. One interesting thing I will say too, is keep in mind always, again, ideally you're calculating present, like you're using financial math, time value money math to figure out, is it better to pay less tax total but pay some of that tax up front versus just deferring it? But there's also one interesting thing in most provinces, just from the basic tax credits that everyone gets, like age amounts, pension credits, obviously your basic personal amounts, just depending on certain situational factors, plus any other deductions and credits people get. But just from like basic personal amounts alone, you can, like in Alberta, you can earn over $20,000 of taxable income tax-free, right? Or by paying maybe just a little bit of federal tax, for example. So it's almost tax-free. So like if you have no other income, I do this for actually quite a few clients who are like in their earlier years of retirement. They have no other income. They haven't started their pensions yet. And they're like in Alberta or whatever, and they've got a $20,000 range roughly where they can have basically just their tax credits are going to offset all the taxes on 20 grand. So I purposefully take out, exactly 20 grand from their RSPs or their LIRAs or whatever it is, right? And then they're basically just getting to take that money out of their RSP tax free.
Yeah, and realistically, it ends up being a lot more than that because like you're still in such an extremely low average tax rate. So it's like even then, especially for a lot of those clients, if you're retiring early, they've got the means to do that and live off those. So yeah, I agree 100%. And the other ones we see a lot, like right now in the GTA in Vancouver especially, everyone's been getting into real estate the last few years, just because real estate's down so much and rental properties aren't, they're not cash flowing. But it seems like every client we have in Ontario has like at least 4 or 5 rental properties. And so they want to dispose of these things, but you're just going to get crushed if you sell and trigger all those gains all at once, right? So some of these strategies, it might take 4 or 5 or 10 years to kind of liquidate all of those investment properties because you have such huge gains on each one every single year. And so building that into kind of that retirement structure where you're actually just going to live off those capital gains, for some of those years rather than drawing down on other income. Because if you do that, then all of a sudden you're spiking your tax bracket. So you see that a lot with those. And then if you are selling off businesses and shares in a company, it's nice to do that in years where you have no other income. Right now, whether those, I'm talking more in terms of like private companies, and that's whether that's like your main source of income, or you're just kind of a one-off investor in a bunch of kind of private businesses as well. But doing those before you start your other income streams, so that you're not dealing with OAS clawback, you're not jumping up into these super high tax brackets and just living off those returns instead.
Yeah, one last one too on that is like try to retire kind of, especially if you're going to get like a severance, try to do it at the new year. Right, if you can,
Jan 1, yeah.
If you can get fired on January 1st or retire,
that's the idea. Yeah, unless you work at, I can't remember who the company is in Calgary right now, but they announced all their layoffs for Q4 this year, like a year ago. So they did it horribly. So you're going to lay off everybody in Q4, but you're making everybody stick around for like a year and a half. And then if they leave and walk away and go get another job, then they lose their severance. It's not an ideal situation for a lot of people. Sequence of returns risk. So not having a properly built retirement income portfolio. We'll see it a lot like fund to funds. Walk us through what that means.
Yep. This is my personal favorite thing to talk about. It's my area of expertise, what I do academic work on and everything. This is pretty much everything we've talked about so far is under there's sub points to the main mistake people make, which is drawdown strategy. This is the second most important, potentially more important even the drawdown strategy, is investing properly for retirement. I wish I could talk about this as much as I want, but regulations do kind of prohibit talking about investments too specifically to a general audience. But sequence of returns risk is, to put it simply, it is essentially the risk that causes people to run out of money or not in retirement, which is basically everyone's concern, right? As it should be, is are you going to be able to live off your investments for the rest of your life? Sequence of returns risk is what affects that. So the easiest way to explain sequence of returns risk is to talk about something that more people are more familiar with, which is dollar cost averaging. So when you're a growth investor and you're on your way to retirement or saving up for whatever you're saving up for, when markets are down periodically, right, when your investments are going up and down and they're volatile, those temporary dips, those present buying opportunities. And I think more and more people are becoming aware of that and comfortable with that idea. Like, it's not a reason to panic. It's usually actually just a kind of a thing to get excited about. Because what happens with dollar cost averaging is when you're putting, say, a regular amount of money into your investments, whenever the price is low, for the same dollar amount that you're contributing, you're able to purchase more of those same investments. So what you're doing is systematically over time, you're lowering your average purchase price, which increases your rate of return, specifically your internal rate of return, which is, without getting into that too much, the rate of return your money actually grows at, compared to the rate of return of the investment itself, which doesn't account for the timing and amount of how much you contribute and buy that investment for. So most people are familiar with dollar cost averaging. I won't hammer that home too much more. But effectively what happens in retirement, and the reason investing for retirement is an entirely different ballgame, is because it all works exactly in reverse. When you're taking money out of your investments on a regular basis, any volatility at all is going to cause you to systematically sell your investments for a lower sale price, which reduces your long-term return. And that's why so many planners, we use really low conservative rates of return to try to account for the fact that even if your investments exactly get 6% and that's what you built your retirement plan off of, the reality is that's not actually going to be the weighted rate of return you get unless you're basically in like a GIC that does 6%, sure. Right? Any volatility at all is going to produce some amount of reverse dollar cost averaging, which is what essentially sequence of returns risk is. And it's going to cause your experienced rate of return, that's the word I'll use, to be lower than the rate of return of the underlying investments or portfolio. And so that's why it is so important to account for this. Probably at some point we'll do a full podcast on sequence of returns risk, how it works, the math underlying it. For now, if you're watching this, that's a great thing to search up. There's lots of articles, lots of papers explaining what it is in general, but it is the biggest risk to retirement portfolios, to whether or not you'll run out of money. Because basically what happens is if you, especially in the early years of retirement, if you get unlucky and investments like markets don't perform well for the first few years, there's almost nothing you can do to recover from that, short of going back to work, or otherwise stopping drawing down your money. So just leaving it in like an passive index ETF portfolio, leaving it in an active, any kind of portfolio that's going to be more focused on growth, less concerned with volatility. That volatility, the same volatility that actually helps you on the way up, can destroy your portfolio on the way down.
And that's specific for a lot of people that have, you're just in, kind of a broad-based market like equity ETF. And then when you're building an actual portfolio, that's why we stress so much for clients is having a proper, income generating portfolio and having a broadly diversified portfolio amongst, various asset classes so that you're always drawing down stuff, that's up or at least isn't down as much. Yeah. And that's, we just see so many people that come to us with, fund of funds. So you just have like every asset class in one, and it doesn't give you the granular exposure to draw from specific asset classes, right? So that's where you get in trouble. Versus if you had, say, 3 years worth of income in, kind of more cash equivalent, style of investments or lower risk asset classes, right? That you can draw from when equities are down, right? That's how you combat that kind of those risks. And I think that's, basically what you're alluding to is, that sequence of returns risk. If you don't account for that and factor that in, that's when you can hurt yourself if you're one of the unlucky people who retires into kind of down markets. Now, you could have that kind of portfolio and you just happen to retire at an opportune time and it never really, kind of affects you. But that's just, it's a risk. And it's a big one, and it can be planned away, right? If you're doing things properly, there's just no need to take that risk unnecessarily. And a lot of people that retired into, a 2022 or a 2018 or even partially 2015, obviously like 2007, 2008, 2001, like there's been a lot of these major corrections.
Yeah.
All those, going even back further. Right, those are things that you can kind of de-risk from, but a lot of people just weren't.
Yeah, and there's this would be such a great podcast to have on its own. For the record, if you're wondering why we are not talking more about this and why we can't go into more detail about how do you address this risk, it's because regulations basically prohibits you from talking anything about investment specific, giving advice to a general audience because we don't know who we're talking to, right? We don't know their situation, their finances, their risk tolerance, et cetera. One thing I do want to say too, and this is another, not even just retirement mistake, but just mistake in general, especially these days, is taking advice from articles, from social media, whatever it is. If you are getting investment advice, financial planning is another thing, but if you're getting investment advice from someone on, say, TikTok or YouTube, and they're telling you here's the ETFs to buy, or here's the top mutual funds to buy, or top stocks, or whatever it is. By legal requirement, those people are not licensed to be saying that, right? Because the people who are licensed are not allowed to give that general advice or that advice to a general audience. So just in case you are getting any investment advice, and I don't know about you, but I start getting it more and more all the time, right? Where someone will have millions of followers on TikTok and be giving lists of ETFs to buy, and then or whatever. It's almost like the modern day water cooler, right? Where people come with these investment ideas that they got off social media largely or articles, no matter how terrible the advice is, but it's like it has a lot of credence because it's a person with 1 million followers on social media. So it seems like a trustworthy source, right?
And regulators are starting to go after that a little bit more. It's not even regulators because the regulators specifically regulate people who are licensed.
Yeah.
So there's not, but I know in the U.S. I think there was the numbers were out today. There's about 1,200 influencers. Influencers that they're going after. Right, for giving investment advice. One was, touting, 40% rates of return and clients lost all their money and all these things. But yeah, you've kind of hit the nail on the head there.
Yeah, just take a bit of a detour. But back to sequence returns really quickly, just to summarize it. It is the risk that causes people to run out of money or not. And it isn't, unless you do something about it, unless you specifically address sequence of returns risk, you leave the success of your retirement up entirely to luck. I guess fortunately the luck is in your favor because markets are up more often than they're down.
Yeah.
But that's like, we're talking 2 to 3 odds or 3 to 2 odds.
Yeah.
Still a lot of luck involved.
I think the numbers from Vanguard came out recently. It was 68% of the time you're better off, kind of lump sum investing versus stock, how often markets are up over a year versus not up. And it's just like, you're just taking unnecessary risk for no reason. And do you want to bet, a third of your life on chance?
Yeah, exactly.
Cool. And then, the last one here, actually, 2 last ones, not income splitting correctly. So, we'll see that a lot where people just don't understand what can be income split and what can't. And rules change, unfortunately. Right in 2018, we had, kind of rules change in terms of income splitting coming out of corporations. That sucked. Fortunately, once you're over 65, a lot of those rules are gone, but lots of people retire well before 65. RSPs, once they're converted to a RRIF at 65, they can be, income split. Most company pensions can be income split, right off the bat. CPP, pension credits can be split at kind of when you go to apply for it, and then OAS there is no income splitting on, right? So understanding the different types of assets you're drawing down on non-registered portfolios, right? If you have things like spousal loans, can be income split, but if you don't, then you can income split, right? Your money is kind of your money. So again, it's all these little things that add up and make a massive difference. And then the last one that we had, not using your accumulation, kind of phase correctly. to build something out. And we see this so often when people kind of don't begin with the end in mind. They're not looking at things from a long-term perspective. They're just trying to maximize stuff today rather than maximizing stuff over your lifetime. Walk us through some examples of what that actually means.
Yeah, for me, like a big thing I do when I'm setting up savings plans is, and probably where a lot of this starts, if you're doing it yourself or whatever, is taking stock of where you are and where you plan to be. Specifically, what is your current tax bracket and what is your expected tax bracket in retirement? Because that's going to feed directly into whether you're better off contributing to RSP, to TFSA, to your corporate accounts, you name it. The very general rule is all else equal, the best time to contribute to your RSPs is when you're going to be in a lower tax bracket, usually in retirement when you take the money out, than you are when you're putting the money in. You get tax savings, a tax deduction at a high bracket. You pay the tax at a low bracket. It's pretty obvious how that works. And a lot of times you find that the opposite is true. If you're currently in a lower tax bracket than you'll be in retirement, then it makes more sense to kind of focus on your TFSA. Again, all in general. And there's even sometimes where, like, depending on how you're investing and what your portfolio is composed of, what type of investment income it's producing, and if it's tax efficient, some people are actually better off just skipping the RSPs altogether and actually just focusing on TFSA and non-registered.
Yep.
Those are pretty rare cases, but
we'll see that a lot with large inheritances, or like, when we're dealing with somebody who's got a family trust and there's $20 million sitting in it and they know they're going to be collecting it one day. It's like, it doesn't make sense to put money into RSPs because you're actually going to be in a higher tax bracket in retirement, and all you're doing is shooting yourself in the foot, kind of by doing it. Yeah. It's all situation based. And the other one to go along with RSPs is things like spousal RSPs. Right, if you're going to be retiring pre-65, and it's so common that we'll see one spouse has got $1.5–2 million between their LIRA and RRSP accounts, and another spouse has like $100,000. Yeah. Right. Once you're 65, it doesn't really affect anything. But if you're going to retire before then, it's nice to be able to draw those down in income split. So that's why you'd contribute to a spousal RRSP. So that you can income split that. And I don't necessarily agree with the rules and the fact that you can't income split pre-65. I think that's a dumb rule the way they have it structured, but it's still a rule. Yeah. Nonetheless, I don't get to change the Tax Act myself, and so I wish. Just looking at those different things during the accumulation phase, and I think that's where you kind of need to get granular with it rather than just kind of
blindly contributing to an RSP.
Yeah, and kind of hoping, right? It's the old adage, like, you don't know what you don't know. And so that's why when we work clients, we do that deep dive, really get into the nitty gritty details so that you're not looking back 20 years from now going like, I wish I'd known that 20 years ago, but it's kind of too late now.
Yeah, it's too late to do anything about it, right?
Yeah, exactly.
I just cut out a lot, but yeah.
So that's all we had for today. Lots of potential, kind of retirement mistakes that people can get hit with. The good news is that there's a billion resources out there that people can go to.
And like 10 of them are good too.
Resources to go to. Obviously, if anyone has any questions, wants to reach out to Dylan directly, work with Dylan. Always happy to kind of answer phone calls, emails, and kind of assist. Thanks so much for thanks so much for joining me today.
Anytime. Thanks for having me.
Right on, man. Take care.